The 25 richest people in America got $401 billion richer over 5 years. On that fortune, they paid a tax rate of 3.4%. Not because they cheated, because 3 simple words explain almost the entire trick: buy, borrow, die. Here's how we actually know this. In 2021, the investigative newsroom ProPublica obtained a leak of confidential IRS tax data. It covered thousands of America's wealthiest people across more than 15 years. The data showed exactly how much they paid in taxes versus how much their wealth grew. This is not speculation. It's their actual, real tax returns. Here's the number that started it all. From 2014 to 2018, the 25 wealthiest Americans saw their combined wealth grow by $401 billion. Over that same period, they paid $13.6 billion in federal income tax. That works out to a, quote, true tax rate of just 3.4%. A median American household pays roughly 14%, about 4 times that rate. Now, you might be thinking, wait, isn't that illegal? No. Every single one of these tax returns was fully legal. This isn't a story about hidden offshore accounts or secret schemes. It's a story about 3 completely ordinary, public, legal financial moves. Once you see how the U.S. tax system actually defines income, it makes sense. Let's start with step 1, buy. The U.S. tax system only taxes, quote, realized income. Money you actually receive. If your stock goes up in value but you don't sell it, that gain is, quote, unrealized. Unrealized gains are not taxed, no matter how large they get. Many billionaires' wealth is almost entirely unrealized stock value, not cash income. Here's a real example. Warren Buffett's company, Berkshire Hathaway, deliberately pays no dividend. Dividends are taxed as income the moment they're paid out. By avoiding dividends, Buffett's wealth grows entirely through stock value. Untaxed. From 2015 to 2018, he reported between $11.6 and $25 million in income, while his wealth grew by billions. But eventually, you need actual cash. So here's step 2, borrow. Stock on paper doesn't pay for a house, a yacht, or daily expenses. The obvious move would be to sell some shares, but selling triggers tax. Instead, the wealthy borrow against their stock as collateral. Banks will often lend 70 to 90% of a stock portfolio's value at fairly low interest. Here's why borrowing is the clever part. Loan proceeds are not income under the tax code. You can borrow millions of dollars and owe 0 tax on that money. You get to spend real cash while still owning 100% of your original shares. Your shares can keep growing in value the whole time. Untouched. Here's another real example. Investor Carl Icahn paid $0 in federal income tax in both 2016 and 2017. He had an outstanding loan of over $1 billion against his holdings. He used the loan for his investments and deducted the loan's interest from his taxes. Asked if this was fair, Icahn brushed off the question entirely. So, don't these loans eventually have to be repaid by selling stock? This is where the third final step comes in. Die. When you die, something remarkable happens to the tax basis of your stock. It's called the step-up in basis, and it can erase decades of gains completely. Let's see exactly how the step-up works. Say you bought a stock years ago for $10, and it's worth $110 when you die. Normally, selling that stock would mean tax on the $100 gain. But your heirs inherit it at a new, quote, stepped-up basis, the $110 value at your death. If they sell immediately at $110, their taxable gain is 0. And that's how the loop closes. Heirs can use that newly tax-free, stepped-up stock to pay off the original loans. The lifetime of borrowed cash is settled, using money that was never taxed. The original stock gains were never taxed either. They simply reset at death. Buy, borrow, die. The loop closes. Let's quickly check. Does India have anything like this? On unrealized stock gains, both countries agree. Not taxed until you sell. On borrowing against shares, India has loans against shares, just like the U.S. has securities-backed lending. Neither counts as income. And on death, India abolished inheritance tax back in 1985, while the U.S. uses this step-up in basis, with an estate tax that only kicks in above $15 million per person as of 2026. So, is this a loophole? This is not tax evasion. Evasion means hiding income or lying on your return. Every move here is fully disclosed using the tax code exactly as written. ProPublica's own reporter put it simply, this is not about tax evasion. The real debate isn't legality. It's whether the rules make sense. Here's why this matters, even if you're nowhere near $1 billion. You don't need billions for the underlying principle to matter. Selling an investment isn't the only way to access its value. Borrowing against it is real. Understanding what actually counts as taxable income is the first step in any tax planning. The core lesson, it's not about hiding money, it's about when a tax bill actually gets created. Let's recap. Buy, hold stock instead of selling it. Unrealized gains aren't taxed. Borrow, take loans against that stock. Loan proceeds aren't income either. Die, heirs inherit at a stepped-up basis. Decades of gains can disappear for tax purposes. Result? Real wealth, real spending power, a tiny fraction paid in tax, completely legally. But here's the twist. A $1 salary isn't modest, it's strategic. Next time, why Steve Jobs paid himself $1 a year and what that has to do with everything you just learned. If this finally made sense of how the wealthy legally pay so little tax, please hit that subscribe button. It's completely free, and it's the single biggest way you help this channel grow and reach more people just starting out. Drop a like so others can find it, and tap the bell so the next episode comes straight to you. See you there.